Good afternoon. This is Meir Valensky with Driving Markets. So you can subscribe on YouTube, Instagram, you've got TikTok, you've got Channel X or Twitter, which is be called. You've also got podcast on Spotify. We're going to be discussing several market events this week and looking forward to seeing what's going to happen regarding equity markets and bonds. So this week, the most essential number coming out was the two inflation numbers, which was CPI, Consumer Price Index, that came out on Tuesday, and Producer Price Index, that came out on Thursday. So what you did have essentially is you've got a drop in both of those numbers. So the US retail inflation, US wholesale inflation, both came down, and that pushed up equity markets, especially the Nasdaq. Nasdaq's gone to all-time highs on the back of cheaper money. So when money is seen as being cheaper, the biggest beneficiary of that are equity markets, and the biggest beneficiary within equity markets is the Nasdaq. Why? Because the Nasdaq is heavily dependent on money. So it looks to bond yields in order to get its direction, or to see where the cost of money is. Remember, the Nasdaq has been pulled up by Nvidia significantly, and Nvidia's is split 10 for 1. So the shares have gone from $1,200 a share to $120 a share. Well, in fact, they creeped up a little bit to $125 a share. Remember, when there is a split, there's a lot of enthusiasm, a lot of trend saying, let's get involved in the shares. So generally the shares will continue rising and then taper off, as we saw with Apple when they did a split, and Tesla. And both Apple and Tesla have underperformed the S&P 500 over the last 5 years. We'll come on to that a little bit later. Let's go back what we're talking about initially, which is inflation. So the official number, which is not correct in my opinion, but the official number is trending down. Real inflation, which is the cost of living, how much it's costing you to do your groceries, how much money is left in your pocket at the end of the day, that I suspect is running at anywhere between 16 and 18% inflation in real terms. Not only that, salaries also cannot keep up with inflation, even though wage inflation is rising, but you're going to have sectors like the leisure department, like leisure or travel is cutting back, restaurants are cutting back. And remember, a lot of blue collar workers are involved in restaurants, and therefore if those restaurants and the leisure industry like Disney or Euro Disney is not making money, then they're going to lay off those blue collar workers. So real unemployment is rising. Again, focusing on those CPI, PPI numbers, let's look at where the bond markets are. Well, Jerome Powell, who is head of the Fed in the US, he pays significant attention to the bond market. He looks at where bond prices are and where yields are, because the bond market makers, they really are the ones that are building in future interest rate levels. So Jerome Powell will refer to them. What's interestingly enough is that the 10-year US Treasury and the 2-year US Treasury are still indicating solid, rock solid interest rates rises or interest rate higher levels over the next year or year and a half. And that's going to be very worrisome for Jerome Powell and his colleagues on the Fed, on the central bank committee. Why? Because if they can't get interest rates down significantly, then the economy is going to struggle. And we can see that businesses at lower to middle level are struggling significantly. They simply don't have the turnover or the revenue to keep their business going. So they will be laying off more and more staff. I did mention just obviously a couple of minutes ago regarding the leisure industry, restaurants and hotels and flights. That is leisure, and that will be impacted by rising costs. Another significant figure coming out is how much available money does a regular employee, a regular person has of his salary coming at the end of the month. Well, that's dropped down from available spending 5% to 1%. In other words, there is less and less money in your pocket and more debt. So you've got higher delinquencies, which is late payments on credit cards. And those are the first types of debt to go in times of economic hardship. And also you've got car loans, which are rising delinquencies, and you've got the highest number of defaults in over 15 years on car loans, credit cards and loans. That is going to put pressure on the US regional banks. The other area which is going to put pressure on the US regional banks, which I've talked about several times on the workshops. If you want to join a workshop or you want to get involved in any type of course, you can also DM me, go onto Instagram, book a place. We just need your name, telephone number, and email. But that's to do with workshops and courses. The other area that is a massive threat to US regional banks is going to be the commercial property sector. The commercial property sector is in severe danger of a crash. There's low tenancies, low rents, empty vacancies, and the landlords who are, in fact, the borrower from the banks, so they borrow the money to buy this commercial property, have now got no income coming in, and they are late payment or defaulting on those loans. And once the banks repossess that commercial property, then that commercial property is going to sink, and the bank's net asset value or their credit book is going to fall, and that's going to put them into more danger in the US. Also, commercial property is likely to fall in Europe, and it is falling in the UK, with rates in the UK running at 10-11% on commercial loans. And that is simply too high for the landlords to really make that property worthwhile, because if the property is empty, then they don't have rents coming in. If they rent it out, they're not getting enough rent to cover their mortgage or their loan payments, and therefore banks globally, and especially in the US, are going to see significant level of defaults and delinquencies rising over the next 12 to 24 months. For example, if you were to take New York area, the East Coast, especially in Manhattan, you've got around about 50 or 60 buildings the size of Empire State Building are just empty. Also, you've got Oregon and Portland, Oregon. You've also got in the West Coast, San Francisco, huge areas due to crime, drugs, and simply downturn in economic activity. Overall, those buildings are looking pretty empty and pretty vacant. So that is going to be the biggest threat to the US regional banks and to the banking sector. Once that implodes, which it is going to implode, then you're going to have a situation whereby the banks are going to have to write off that debt, and they're going to have to get a load of assistance from the Fed and Janet Yellen at the US Treasury in terms of funding or mergers, or a load of printing is going to have to be done to bail out the banks. This bailout is going to be bigger than the 2008 bailout. Remember, this started back in 2008. There was a banking crisis back in March 2023 with Silicon, Signature, First Republic, and Citizens Bank. All those banks went bust. So this US regional bank crisis is a particular issue. It's going back to equity markets. Equity markets are fully valued or overvalued, which means there is not enough value in there for you to go invest short term. Longer term, maybe if the companies make all those profits, but the NASDAQ is at an all-time high and pushing backed up on the semiconductor ChatGPT AI industry or sector, which has driven the NASDAQ higher. However, the drive has not been broad-based, and because it's not broad-based, that in itself is a problem, simply because they haven't got enough depth in market to support the rise in the equity market. So you could see the markets roll over. As far as the UK 100, FTSE 100 is concerned, that's very concerned about the election, with Labour now looking that they're going to get in. They've got the biggest percentage. The Conservatives have simply made a cock up of it, and they're not going to get back into power. And therefore, the UK 100 is reflecting that turmoil within the UK, and that's trending down also. Be interesting to see what happens to GBP, the pound, over the next coming weeks, if it's going to respond positively or negatively to the polls, as it looks like Labour is going to get in. That's it for now. So I've got books on Amazon. You can subscribe to this channel. You can check my books out on Amazon, as I said before. We've got courses, workshops. You can join. You can follow me on Instagram and on TikTok. This is Meir Velensky with Driving Markets. Have a great weekend.